After imposing tariffs on steel and aluminum, President Trump announces a $50 billion tariff on Chinese imports, and the market is down big time today. Are Trump's tariffs anti-trade? And what's the next for the markets? Is it good or is it bad? LEI increases for the 5th straight month, but is that enough to overcome the tariff scare? U.S. small cap stocks continue regaining strength on the relative rotation graph and bracing for volatility with Trump's policy changes. Is even more volatility ahead? Do you know what's in your portfolio? If you don't, you should. If you want to know, we can help. Here's what's moving the markets and your money. I'm Charles Brown. It's Thursday, March 22nd, and this is CB3 on 3.
At CB3 Financial Group, we don't just manage your assets, we become one of them.
CB3 on 3 analyzes 3 influences, political, fundamental, and technical, on market behavior, which thus affects your money. Together, these influences determine the movements in all the portfolios that we manage. Here's what we're seeing this week. In political influences, it's just been announced. President Donald Trump is planning to levy tariffs on about $50 billion of imports from China, as well as impose restrictions on technology transfers and acquisitions by Beijing. This strategy is designed to pressure China to curtail what the U.S. considers unfair trading and investment practices. Currently, every $1 billion in trade with China costs the U.S. 6,000 jobs. And that is why the Trump administration complains that the Chinese use intimidation to acquire U.S. technology, putting U.S. firms in China at a disadvantage through unfair licensing deals and siphoning away of U.S. jobs. Here's my take on the political implications for our investments. Section 301 of the U.S. Trade Act of 1974 authorizes the U.S. President to take all appropriate action, including retaliation, to obtain the removal of any act, policy, or practice of a foreign government that violates an international free trade agreement or is unjustified, unreasonable, or discriminatory, or that burdens or restricts U.S. commerce. That is a wide swath of power. President Trump also put China on notice that their egregious theft of intellectual property will no longer be tolerated. Today, the stock market is reeling with the uncertainty of these actions, yet, in the long run, protecting U.S. corporate intellectual property from China's thievery can only strengthen our technology sector and our portfolio holdings. In fundamental influences, the Conference Board's leading economic indicator, also known as LEI, increased for the 5th consecutive month in February, fueled by positive contributions from most of the components, except for the building permits and stock market prices. So, even with the stock market down last month, in the 6-month period ending in February, the LEI increased 4%, which is faster than the growth of 2.4% during the previous 6 months. In addition, the strength among the leading indicators remained very widespread among the constituents in the index. Here's my take on the fundamental implications for our investments. In the midst of other bad news, the U.S. LEI rose again, even despite a sharp downturn in February stock market prices and weakness in housing construction just in the month of February. To me, this LEI report points to robust economic growth throughout the remainder of 2018. LEI's 6-month growth rate has not been this high since the first quarter of 2011. And even though the Federal Reserve is on track to continue raising its benchmark rate for the rest of the year, these important leading indicators signal to me that we and our clients need to remain fully invested in all of our portfolios at this time. In technical influences, the Russell 2000 Small Cap Index, after dipping into the lagging quadrant, meaning small caps were lagging all world indices, has now re-entered the improving quadrant. This is an improvement over last week's report. We call this a jackknife move when an indicator is headed in one direction and then jackknifes back in the original direction from which it was headed. If the small caps can continue into the leading quadrant, taking some leadership, it bodes well for the overall U.S. stock market. But yes, volatility has returned to global markets in 2018, but yet don't assume the worst for the remainder of this year. Temporary swings are a normal part of equity markets and are often influenced by short-term news such as the tariffs I've discussed here in this episode. Truthfully, what was unusual for the markets was the calm in 2017. Now look at this chart. Do you see that even with lows that were negative, most years closed positive? That's why you shouldn't make decisions when you're emotionally distracted by current market volatility. Intra-year declines in the S&P 500 have averaged 14% since 1976, but index returns were positive in 31 of 41 years. The lesson for the investor is this: remain calm and stay the course. And that's CB3 on 3 for Thursday, March 22nd. What's in your portfolio? If you don't know, you should. If you want to know, we can help. I'm Charles Brown, and at CB3 Financial Group, we don't just manage your assets, we become one of them.